In the early morning of May 8, to prepare for the 4CRV pool, Luna Foundation Guard, LFG, a Singapore-based non-profit that maintains the Terra network, removed $150 million worth of UST from the UST3CRV pool. At this time, the TVL of the pool was around $700 million. In other words, it cost only about $300 million to drain this pool. To keep the balance of liquidity in the UST3CRV pool, LFG removed another $100 million worth of UST from the pool. On the evening of May 8, whale trades, a whale alert account on Twitter, began to ring alarm bells frantically. As a result, UST plummeted all the way to $0.6. On May 11, USD seemed to be shorted by Soros-style short sellers, and has plummeted to a minimum of $0.2998, source, CMC, after rounds of underselling. It was a terrifying day on May 11. There seemed to be short sellers deliberately shorting UST and Luna while liquidity is being withdrawn from the UST3CRV pool as reserves for the 4CRV pool. A single wallet dumped $350 million worth of UST on Curve, making UST lose its peg to the US dollar. In response, LFG sold BTC to keep the peg, and then the short seller dumped the rest UST on Binance. USD was seriously depegged, followed by a run on UST. LFG then came to the rescue with a plan to lend large amounts of BTC, only to cause a nosedive in BTC. Since new Luna is minted by burning UST, the supply of Luna has increased instead, resulting in its slump. The profit from short positions of BTC and Luna of the short seller is estimated to exceed $1 billion, and the cost, mainly the UST dumped, is estimated to be within $200 million. Considering the close relationship between projects in the Terra ecosystem and Luna and USD as well as the reinvestments and profits of DeFi Legos, the UST depegging has dealt a heavy blow to both the Luna margin and UST margin staking, DeFi, lending, margin, and other protocols and the prices. What's worse, it even directly triggered the liquidation of protocols, pushing Luna and USD into a secondary death spiral. 1. Anchor. As a decentralized savings protocol built on the Terra ecosystem, Anchor boasts a stable APY of 20%, which is its most prominent feature. Influenced by the UST depegging, Anchor's APY rests at 18.9%, but its total deposits plummeted to $3.99 billion from $14 billion last Friday, as suggested by Anchor's dashboard. As a supplement to the Anchor and Terra ecosystems, Orion Money is designed to facilitate the conversion of other stablecoins such as USDT and DAI into UST for earnings on savings in the Anchor ecosystem. Specifically, investors stake Orion and enjoy considerable returns with 10%, 15%, and 20% APYs. With the UST depegging, the stablecoin stakings on the Orion protocol have slumped by more than 50%. 2. Mirror. The synthetic assets in Mirror are all minted with USD as the main collateral to mirror various financial assets such as stocks and ETFs. Therefore, the investment demand for any US stock-based synthetic assets in Mirror will eventually turn into the demand for UST, which creates the most important usage scenario for the stablecoin and provides value for UST and Luna. The TVL of the Terra chain on Mirror fell from $600 million to $240 million, a drop of 60%. 3. Lido and node staking. Lido, the largest liquidity staking protocol, started the liquid staking for Terra plan as early as last year, releasing the Luna staked by nodes in the Terra ecosystem. The Luna staked on Lido also witnessed a drop of about 60% as well as frantic underselling. As a result, the TVL of Terra's staking in Lido dropped by 80% on May 11th alone, with a 7-day drop of a staggering 91%. On the other hand, node staking directly affects the verification and security of the Terra network. For the time being, we haven't observed a large number of nodes fleeing.